Okay, it is now recording, and this is week 3, and we're going to be talking about finance. And I just sent you all the recording for week 2, and I would appreciate it if somebody would actually go in and listen to it at some point, make sure it's all working, and it should contain the audio file and the video audio file. So that's what I'm hoping. Let's take a look here. What we're going to be talking about is finance, and so financial management is one of the key sections of the CPRP exam, and is based upon 14 finance tasks and represents approximately 17% of the items on the exam. So probably a good section to review. The chapter that I'm covering in the book will cover all this, all the items that are on the exam in their entirety, and then as well as should the online tutorial that you've been taking all along. So financial management is defined as the overall coordination of financial resources. It includes developing a budget to guide the use of funds over a period of time, and usually it's our fiscal year. Fiscal years can change back and forth. If they ask you a question, usually it's July to June. Also, it includes developing, not just developing the budget, but using alternative funds to meet the organizational goals and objectives. And then finally, understanding the processes for purchasing and handling cash. It's our responsibility as professionals, but it's also shared with other employees in the organization, as staff will most likely have budget development and monitoring responsibilities over certain programs and events, program areas, or even the entire department, but typically it's on a smaller granular scale that they operate their own budget. The first section that we're going to cover today is collecting financial and/or operating data. Attendance, revenues, and expenditures. So in order to gain an understanding of the operation of an agency, it is necessary to collect financial and operating data. Depending on the data, they may be collected daily, weekly, monthly, quarterly, or annually. These data assist in accounting for cash handling, revenues, and expenditures. And the following, I'm going to tell you, is the data collected in public parks and recreation. So one of the first sets of data is attendance figures for like events, programs, and facilities. And this is usually necessary to predict future program participation, justify increasing or decreasing staff, or defending budget increases. The second method is room counts in facilities. And if you have basically a busy area, it can be conducted on a daily basis, room counts. It can be conducted on an hourly basis. This is used to demonstrate what the capacity of the facility is actually, what part of the facility and the capacity is actually being used. And then this is probably a test question in the future. Staff in a busy facility will most likely do room counts hourly. The third one is cash reports, including daily revenues and gate receipts. And this reveals how many people come to a facility, how much admission they are paying, and how much in goods and services they are purchasing. Maintenance reports detail work requests that were completed. Maintenance reports, I'm sorry, that's number 4. Basically detail the work requests that were completed, those still pending, and those scheduled to be completed over a specified time frame. These reports are used to show workflow, productivity, and repairs made. Now, these activity reports can encompass a wide variety of things to be tracked, and they're usually customized based on the program area. And I'll give you an example. An ice rink may keep activity records of the number of participants, the number of lessons, the number of gift certificates sold, the number of skates sharpened, or the number of skate or facility rentals of the day. The next section is implement cash handling practices, which is retail sales, rentals, fee collection, deposits, and petty cash. So direct revenues from operation of park and recreation departments are frequently collected at several recreation facilities, as well as a central office. To establish a systematic accounting that will discourage dishonesty, reduce some potential corruption, and avoid participant criticism, these following devices and techniques should be employed. And they give us 9 to consider. Number 1, post a schedule of fees in plain sight at all locations. Number 2, require at least 2 employees to be at the admission entrance at recreation facilities. 1 employee accepts the admission fee and returns a numbered ticket to the participant. The other employee collects and cancels the numbered ticket at the entrance. That's a good example of check and balance. Number 3, when the amount of business does not justify 2 employees, the cash register is an acceptable control device. So again, if they do ask you, when the amount of business does not justify more than 1 employee, that cash register is an acceptable control device. And basically, the theory supporting this is that the cash register is something that the purchaser can see and that the payment is recorded. Number 4, reconcile all cash register receipts to ensure that cash and ticket counts reflect recorded frequency and monetary totals. Number 5 is rotate attendants responsible for receiving cash payments through different facilities and work schedules. Number 6, many registration systems have receipt capabilities that track incoming cash. If this is not the case, then receipt booklets can be used. Miscellaneous payments should be recorded using a numbered receipt in triplicate. 1 copy is given to the participant, and the second one is sent with consolidated remittance to the control office. And the third is retained at the recreation site. Only carbon copy receipts should be used for this purpose, and they should be kept in a bound book. The book of receipts, well, numbered receipts, I want to make sure you understand it's numbered, should be issued from the office, and employees should be required to account for all receipts issued to them. Collections should be deposited daily. However, collections are often made too late in the day for bank deposits and must remain in the office overnight. In this case, a proper safe or other equipment must be provided for the protection of such monies. Number 8, all keys to lockboxes, bank bags, cash registers, and safes should be only available to authorized supervisors and not available to the attendants. And the last one is schedule frequent unannounced visits by internal auditors who will review the inventory of tickets, count cash, and review the cash handling procedures. Okay. The next section is purchase supplies, equipment, and services for program activities. When authorized by the agency, staff members may buy goods directly using established agency procedures and forms. After the employee has asked for approval to buy something, usually through a requisition, typically one of 4 procedures is followed. It's either a purchase order, a P card, a credit card, or petty cash. And purchase order, there is a test question coming up on this. So a purchase order is an agreement that the agency will pay for goods and services ordered. And there's 2 different types of purchase orders. One is a blanket purchase order, and those are used to consolidate small continuous purchases. It is essentially an account that is billed once per month. Blanket purchase orders are often used, for example, by maintenance staff at a hardware or supply store. For items bought regularly, this is a more efficient method to purchase items. Then there's a standard purchase order, and they're issued for a one-time delivery for a specific good or service. And usually they require authorization by the chief executive officer or designee. When the good or service is delivered or paid in full, the order is complete. The next one of 4 procedures that are followed for buying supplies and whatnot is a purchasing card or P card. The P card is used for business, nonprofit, and government units, and it works just like a personal credit card. It has a limit on spending and is used by the agency for agency purposes. A P card can also be designated for a specific amount so that it may only be used at a particular business. At the end of a month, a detailed billing statement is issued where all items purchased are detailed. The accounting department pays the issuing company, like Visa, rather than each individual business, saving the agency time. The next one is a credit card. The main difference between a credit card and the P card is billing. Credit card statements have less detail and require additional time for accounting staff to reconcile each bill. The P card must be paid in full at the end of each month, whereas a credit card can carry over a balance. Furthermore, monthly use fees are typically higher for credit cards than P cards. And the last area is petty cash. And there's a test question here under petty cash. Petty cash is the actual cash kept on hand for small purchases that do not warrant a purchase order or the use of other methods of payment. Petty cash is tightly controlled by the accounting department, and petty cash funds are established by the agency, units of the agency, to cover payments or miscellaneous purchases not to exceed a specific amount, and it's typically $100. No specific purchase may exceed the limitation, and succession purchases may not be made to circumvent the limitation. And so that should be pretty self-explanatory, but I just want to explain it so that if you have, if your limit's $100 and you buy something for $80 and something for $50, in order to circumvent that $100, it's cumulative and you can't do that. Typically, no expenditures may be made from petty cash for personal services, meals, or travel expenses. Petty cash is designed for small, quick purchases that are most efficiently made with using cash rather than following the lengthier purchasing procedures. Petty cash funds are stored in a secured locked cabinet or safe with limited access to the area where the funds are located. The petty cash fund custodian is responsible for the cash accountability, its safekeeping, and proper use. The custodian, and they're calling the person that's overseeing the fund is called a custodian in this case, does not, and they have about, let's see, 6, looks like 7 items. So the first one is, this custodian does not permit access to the cash in the fund by anyone for any reason. Keeps the fund physically separate and does not mix it with other funds. Keeps the fund secure at all times. Does not use the petty cash fund as a charge fund. Does not make simultaneous purchases to circumvent the spending limitations. Reimburses only funds expended. And it must secure a receipt for each expenditure. Receipts should show the date, the amount, a description of the purchase, and be imprinted with the vendor's name or identifying logo. The accounting staff maintains the petty cash fund in a consistent state of reconciliation. Therefore, cash plus expenditure receipts on hand must always equal the amount of funds that were advanced. Vouchers to reimburse petty cash funds should be processed as frequently as warranted by the expenditures. The purchasing process is also in this section. And so when making purchases, it's important to follow the proper procedures established by the agency. There will be limits placed on the purchasing, including a maximum amount of money that can be spent without supervisor approval, the maximum amount that requires higher level approval, and the spending limit that requires a formal bid. A formal bid may be dictated by state law, or it just might be your own internal policy. Below, following is the typical purchasing process for items following below the bid threshold. So this is the process that you have to follow according to the book. 1 through 5. Number 1, request a purchasing requisition. And this will outline the purchase and requires the proper permission to make the purchase. Obtain quotes. Agencies will establish a specific purchasing level where quotes are required. And this policy will establish how many quotes must be attained prior to a purchasing decision being made. The third one is to determine the means of purchasing. In other words, will it be a purchase order, a P card, or one of the other ones we just talked about? Number 4 is make the purchase and receive the goods. And then number 5 is submit the receipt to the purchasing department and accounting department. Okay, I'm going to pause there and see if anybody has any questions. Just type it in the chat box or unmute yourself. That I don't know, Becky. P cards are really, I don't know. That's a good one. I would ask your, Becky, because it's a good example, maybe you could report out next week or via email to me and I'll send it out. But the question is, if gas cards that say Arizona on them are P cards, and really it's about how they're managed. Remember, the P cards are paid off every month in their entirety. They have a limit on spending. So does a credit card, but I'm just trying to find out what the differences are. Let's see here. So they can also be designated for a specific account so they can be used at a particular business. So does the gas card, is it like just for Chevron or something, or is it like any sort of gas card? Can it be used anywhere? That was a question. Okay, it can be used at any gas station. I would ask your accounting department. I'm interested, and it sounds like a couple other people are interested too. So can you do that for us, Becky? Okay, good. Any other questions? All right, good. So let's go on to prepare requests for alternative support. And these would be like grants, donations, sponsorships, in-kind services, and matching funds. So this is kind of funny because this is a whole section, and then it tells you to go to the next section to find out the answer. And so it even says, see the next section for methods of researching and preparing requests for different types of alternative support for agencies. So we're just going to combine the two, I suppose. So in preparing requests, it's also research sources of alternative support, grants, donations, sponsorships, and in-kind services and matching funds. So under grants, there is a test question coming up. Grants come from state and federal government programs as well as private foundations. A broad range of federal funding assistance programs exist for parks and recreation. Popular granting programs encompass categories such as youth, health, trails, and the environment. Grant programs exist for a limited time period typically, and funding from state, federal, or private foundations will ultimately be terminated. So we must be prepared to assume financial responsibility for grant-funded project, or do away with the, or do away with it actually. Some of you may have already experienced this, but sometimes, you know, when you go for a grant and it doesn't meet the time frame or it doesn't meet the exact intent, even if you did qualify, you might not be able to get it. It also may have conditions that you can't adhere to. So if you have to assume financial responsibility for a grant-funded project, and you find out that you can't do it, you have to basically give the grant back or deny it. Many parks and recreation agencies use federal or state grant funds for capital projects such as land acquisitions or trail construction. When the capital projects are complete, the agency is left with the operation and maintenance cost. So they usually cover the capital cost, and we usually assume afterwards the operations cost. One type of grant that's popular in parks and recreation for capital projects is a matching fund grant, where the granting agency will give money if the agency can match the grant dollar for dollar. That would be a full 100% matching grant. If there's also 10% matching grants where the agency pays 10%. And so that can vary, but this one refers only to the 100% dollar for dollar match. To obtain a grant, the agency must complete 3 steps. You have to plan the project, you have to search for funding opportunities, and you have to write and submit the grant proposal. Prior to searching for the funding agencies, it is important to know the details of the project. You do not have to know every minute detail. However, knowing the overall scope is important, especially the expected outcomes. These details help in the search for grants. Most funding agencies will get a large number of applications. If a project is not a good match for the funding agency, it will most likely be rejected. When searching for grants, look to the state government agencies, private foundations, and federal grants. There are several websites where grants can be found, such as foundationcenter.org. Once a granting agency is found, it is time to write the grant. Each funding agency will have different specifications for the application as well as the project itself. The application must precisely match the application criteria. This includes the order, even the order of the documents, the formatting, and if you don't do it correctly, it will most likely be rejected. Here's a list of items most often found in a grant application, and there's 7 of them. So there's a cover letter, an executive summary, and that's usually a 1 or 2 page statement, summarizing the contents of the package. The third is a problem statement and need description. And this is probably the most, and this may be a future test question as well, arguably the most important aspect of the grant is the problem statement and need description. And it should demonstrate why the project is important, why it needs funding, the benefit to the community, how progress and outcomes will be measured, and how the project aligns with the grant. It should address any questions that are outlined in the call for the grants made by the funding agency. The next one is a work schedule of all the work to be completed. And this should show the project from start to finish, and anybody else that's involved with carrying out the project, like another nonprofit or partner. The next step is the budget, and you should include a budget for the project. If the grant is a matching grant, be sure to demonstrate where the matching funds will come from. The budget should be quite detailed to show how the grant will be used. And some grants are very strict regarding how funds are to be expended and do not allow monies designated for one line item to be used for another. So be really careful when you designate these line items. For example, if you put planning at 10% of your budget, it comes in at 15, you may not be able to have that funded. This next section is qualifications. Present the qualifications of the key individuals working on the project as well as those of the agency itself. And this is a good time to show past projects and the agency's ability to manage and deliver them. Number 7 is appendices, and include any appendices that the funding agency requests. This could include a master plan, a strategic plan, site plans, if the grant is for construction, or letters of support from partners or community members. And oftentimes it doesn't say it here, but as you probably already know, a resolution from your elected officials is sometimes necessary to go with the grant application. There are many reasons that grants are not awarded and that are fully funded under the control of the agency. They include a submission that did not follow the guidelines, missed deadlines, a project that does not align with the grant, a poorly written grant, an unrealistic budget. And so for us, careful attention to these details can improve the chances of receiving the grant. The next topic area is gifts, donations, and planned giving. And these are funds and items received from individuals through wills, life insurance policies, and donation of land, stocks, and personal property, and even cash. And this is prior to or upon a person's death. So people can donate stocks, bonds, personal property, or land to agencies, and the agency can retain them and build upon their value or sell them to use the revenue from the sale. In addition to these items, an individual can take out life insurance policies and name the agency as a beneficiary upon an individual's death. The money then would revert to the named agency. What it doesn't say here, and I don't think it says it later on, sometimes they come with conditions, even in the ones that were just stated above. And so those were absolute statements. But we all know that these type of funding sources sometimes come with limitations. So asking for these types of income sources requires a special skill set and a thorough understanding of the giving process. And so that's for us staff members on Parks and Recreation. There's a lot of people that are very adept at going after planned giving types of money for their Parks and Recreation department. But typically, if you have a foundation, that's where that would happen. I'm just trying to give you a practical example. Many parks and recreation agencies are just beginning to explore these options, although they have been eligible to receive these types of gifts for decades. That is true. They often are approached by a donor rather than approaching the donor to request a gift. Making these types of requests requires an understanding of what the agency wants and needs, cultivating potential donors by establishing relationships with them, and finally asking for the donation. To be successful in this type of fundraising, an investment in staff training needs to be made. It is unrealistic to expect someone with no training in fundraising to be successful. With this type of fundraising, agencies must establish a policy on what it will and will not accept as gifts. Not all gifts have to be accepted, and it's okay for the agency to turn down a gift. It could be that the item does not fit with the image and philosophy of the agency, it costs too much to maintain, or there is no way for the agency to benefit from the gift. For example, let's say a land developer chooses to donate, this is their example, by the way. A land developer chooses to donate 5 acres of land to the agency for a park. If the land is not in a location that meets the goals outlined in the park's master plan, or if it's expensive to operate, or if the cost of development is too great, the land gift may have to be rejected. Sponsorships. Sponsorships are generally obtained in the form of cash or in-kind services whereby companies donate needed supplies, equipment, or staff time and skill. With sponsorships, the agency benefits from the monies or items received, and the company who is a sponsor receives recognition or a marketing benefit, usually in the form of media ads, logos at events, or access to participants. Sponsorship should not be seen as a donation, since the sponsor expects to get something in return. Thus, the agency has to have a well-thought-out sponsorship proposal to show the value of what is offered and what the sponsor will receive in return. Potential sponsors will want to ensure that the target markets of the event and the sponsoring agency are aligned, as the sponsor is most likely to use the event to draw customers. Sponsors can be found at 3 levels. They can be local businesses, regional businesses, and national companies. Local businesses are well suited to support local events that are smaller in scale. And as the event grows and attracts more people, regional and national sponsors may become interested in sponsorship. The higher the level of exposure of the event, the higher the cost of sponsorship and the increased likelihood of drawing a national sponsor. Now you can expect that sponsors are probably seeking some things. So they like to have, for example, naming rights to an event, public awareness and image enhancement, product distribution, marketing opportunities, hospitality opportunities for their own customer. And they give an example as, for example, like box seats at a baseball game for potential clients. So sponsorships can range from something as small as $250 soccer sponsorship to the use of a refrigerated truck for a food event, or naming rights to an event that draws more than 1 million people. Each type of sponsorship is handled in much the same way, with bigger events requiring a much more extensive sponsorship proposal than smaller ones. But here's what a sponsorship proposal should include. And there's 3 items. The first thing it should include is the history of event property. So history of the event or the property, give an overview of the event, how long it has been in operation, and the current sponsors. Then it should include logistics, provide the details of the event, including but not limited to the date, time, location, goals of the event, schedule of events, activities during the event, layout of the venue, budget, previous 5-year financial statements if available, a marketing plan including advertisement and publicity, event staff, and last year's top 5 sponsors. I really find it interesting, this is my own personal note on this, that they didn't include attendance, but they did talk about everything else. So the third one is benefits of the event. The benefits, such as the role it plays in the community, the target market of the event, and how it matches the sponsor's customers, the number of room nights that are projected for people staying overnight, how the company's image will be enhanced, and the economic impact for the community. This is the opportunity to sell the business on your event, is during this section of benefits of the event. And I think I said there was 3, but there's actually 4, so I apologize. There was 4 sections. So establish sponsorship packages. For large events, there are usually several levels of sponsorship. For example, an event might have 4 levels if it is large enough, including these 4 areas. There's a title sponsor. And this is naming rights to the event. So often including the first right of refusal for other sponsors. This gives the sponsor the largest amount of publicity for the event. The presenting sponsor is the second level of sponsorship. Typically 25 to 50% of the value of the title sponsor. And it receives less publicity than the naming sponsor. So in this case, if the title sponsor was a $10,000 sponsorship, then this would be $2,500 to $5,000. The next one is an official sponsor, and this is approximately 10% of the value of the title sponsor. So again, in my example, that would be $1,000. It is a good sponsorship level for smaller businesses that want the benefits of being associated with the event. And then there's the last one is an official supplier. Less than 10% of the value of the title sponsor, most likely involving the provision of goods or services, such as in-kind services. Okay, excuse me. So before bringing the sponsorship proposal to a business, do research to know whether the business is a good match. Know who they are, who owns the company, what other events they sponsor, and what their mission and values are. So if a company traditionally supports youth activities, taking an adult event to them might be wasting time and resources. Develop a database with potential sponsors and learn as much as possible about them. Information can be found in an annual report, website, newspapers, by talking to the staff and networking in the community to get to know their staff. Before attempting to secure any of these alternative funding sources, agencies need to have a plan in place setting forth what they need and how they should secure the needed funds. The lack of a solid plan can result in expending significant resources with little return on the investment. That was a pretty big section called sponsorships. And so any questions on that? I'll pause while I get some water. Okay, let's see here. No questions. Okay. Hopefully nobody's fallen asleep yet. Okay, so the next one is conduct cost recovery analysis for a specific area in order to recommend fee schedules. And now we're going to start to get into a couple of these charts and formulas and stuff like that. So if you can't see the screen, if you're on a phone call or something, don't worry about it. You'll get the recording probably this weekend, and you can go back and watch it. So regardless of whether the agency is public, nonprofit or private, fees and charges are established in accordance with the agency's mission and financial objectives and are key to conducting a cost recovery analysis. Pre-establishing subsidy levels for programs is a popular means of controlling pricing decisions and setting fees and charges. For public and nonprofit agencies in particular, policies outline what level of cost recovery, and they have it in quotes, subsidization, because if you subsidize something, that's the level of cost recovery it relates to that. So that different types of programs must achieve. So let me read that again. Policies outline what level of cost recovery or subsidization that different types of programs must achieve. Programs will be earmarked to make a profit, break even, or be subsidized with other revenue streams. So they give an example, and I think it's a good one. So youth sports may be designated to be subsidized at 70%, whereas adult sports may be required to make a 30% profit. These subsidy levels should be established with the input of staff and be realistically achievable. It is not uncommon for agencies first establishing subsidy levels to develop a plan over several years to reach the projected subsidy targets. Before establishing cost recovery levels, the cost of the program must be determined. To determine the actual program cost, one needs to understand the program demand and cost. So we're going to cover demand and then cost. Demand for a program is the minimum and maximum enrollment for a program or the projected number of participants at an event or facility. It is the professional's responsibility to identify and understand the market factors that affect program participant levels. Knowing how many people will participate in a program is of paramount importance in establishing a proper price for the program. Estimating demand is both an art and a science. It requires an understanding of the needs and the interests of the community as well as their ability to participate. Tracking programs over a number of years gives a good indication of registration expectations. In addition, following trends and analyzing how quickly the community responds to them, whether they are fast adopters, middle adopters, or late adopters, can indicate how new programs will be accepted. A thorough examination of the competition for similar programs can also be used to estimate demand. The art side of estimating demand is a gut reaction and what experience the community tells the programmer. In other words, what experience with the community gives that programmer a gut reaction. These feelings are often an accurate means of gauging interest. When establishing a price for the program, it is best to underestimate demand and overestimate cost. So again, I want to make sure that's clear to everybody. They say it here, so when establishing a price for the program, it is best to underestimate the demand and overestimate the cost. So under cost, in order to establish a price and analyze cost recovery levels, it is necessary to know the direct and fixed costs, the changing fixed costs, and the variable costs. Fixed costs are those that do not change with the number of participants and remain constant for the duration of a program. So fixed costs can be categorized as direct fixed cost or indirect fixed cost. A direct fixed cost are a result of conducting a specific program. If the program did not take place, the cost would not be incurred. So an example of a direct fixed cost, would be the cost of renting an activity room for an exercise class. Regardless of the number of participants, the rental fee remains the same. Indirect fixed costs are often referred to as overhead costs. The exercise class referred to above may be one of the classes operated by the agency. Each class is required to absorb a share of the costs associated with administrative expenses, utilities, maintenance, and debt payment, etc. These costs are incurred by the agency and are necessary for operation, but they are not directly traceable to a specific program. They are fixed because they remain the same regardless of the participant enrollment. Parks and Recreation agencies may vary in how fixed costs are assigned to programmatic areas. Two popular approaches used include equal share allocation, where each program area pays an equal share of the indirect costs, and a percent of budget approach, where the program area pays the percentage of indirect costs that is equal to the percentage of the overall budget that the program area commands. Regardless of how indirect costs are allocated, they must be realized in order for the total cost of a program to be determined. So if you look on the screen, I don't know if you can see my mouse or not, but right here, this two approach applies to allocating $100,000 of the like the director, or in this case, they call it the CEO. So here, equal share, you can see there's 4 different areas, programmatic areas, excuse me. And then below, it's a percent of the budget. And so you can do it either way. So you can do an equal share, or you can do a percent of budget. Hopefully that's helpful to everybody. Any questions on that? Looking at the chart. You can unmute yourself if you want to ask, or you can just type it in. Okay. There's also changing fixed cost. And these are the costs that change by volume and not by individual participant. So this is like teacher to student ratio. So if one teacher can teach 12 participants, and more than 12 will require an additional instructor or teacher, the instructor is a changing fixed cost. So the cost for instructors increases with each unit of 12 participants. In order to establish fees, variable costs must be determined. Variable costs are those costs that result from the actual operation of the program and charged directly and proportionally to the number of people enrolled. For example, if participants are given a t-shirt for enrolling in the program, these shirts are of a variable cost. So here's a formula here. It's at the top of your page. Everybody should see this. And once the cost formula information is gathered, the break-even price is realized by using the following formula. And if you want to take a picture of this, I don't know if you've seen it already in your materials, but this is, they may ask you about this. So P is equal to F plus V divided by N. So P is the price, F is all the fixed costs, V is all the variable costs, and then the demand for the program, which would be the number of participants. So if you look below, I'm going to bring this up now. So this is an example of a ice rink budget where the manager is trying to determine the cost per hour to operate. And of course, this is a very simplified budget just for this example. The rink is open 7 months per year, which equates to approximately 2250 hours, 2,250. In this example, rather than the number of participants being the demand, the open hours represents the demand. So you have all your fixed costs, capital, administration, ice installation removal, basic maintenance, basic services, and then multiplies by 7 months to give you your total fixed cost. And then your variable cost are supplies and equipment, and those come over as a full number because it's for the entire period. Total variable cost is $50,000. So if you add the total variable cost of $50,071 plus the $56,425, you're going to get the total F&V cost, which is $106,496. And so that would be F plus V in the formula above. I'm going to bring that back up. So that would be F plus V is $106,000. And then the cost per hour is 22. This is the demand. And that equals $47 per hour is what it costs to be able to, that's your break-even price, if you will. So although the actual cost of the program is now known, this doesn't necessarily mean that this is the price fee that is charged to every participant. Participant prices and fees are driven by established subsidy levels, what the competitors are charging for the same service, and market pricing, which is dictated by what the market will bear and how much people are willing to pay for a particular service. Agencies will establish their cost recovery levels for each type of program based on the agency's philosophy. And this will be certainly a test question. Most agencies will consider whether the services is a public, merit, or private service. I've heard other terms called, but for today's purposes, private, merit, or public service. Public services are offered to the public at large and benefit the community as a whole. Parks, trails, and playgrounds are often considered public services and usually do not have a fee associated with them because they benefit the people using them as well as enhance the livability of a community. Thus, they are 100% subsidized. A merit service usually has a partial cost recovery. So this is merit service now, partial cost recovery. In other words, some costs are recovered from fees and charges, and some of them are subsidized with tax dollars on public agencies or from other sources in commercial and nonprofit agencies. And they give an example, which is really a good one actually. Teen after school programs may be considered a public service because the money saved when teens are engaged in healthy recreational activities after school. I would go a little bit step further and say, i.e., they are not involved with crime. They help build their self-esteem and all this other stuff. But that's, I believe, is the money that they're referring to. So the teens may be charged a modest fee and the remaining costs subsidized by the agency. The last type of service is private services, and they're for the benefit of the individual participating in the activity. For example, a cooking class for adults could be considered a private service and expected to either break even or make a profit. Agencies will classify their services to set cost recovery rates. And I don't think they give me an example of this. They might. Let me just cover this again. The cost recovery rate is a percentage that the program will either subsidize, break even, or make a profit. So let me repeat that. The cost recovery rate is a percentage that the program will either be subsidized, break even, or make a profit. For example, a break-even cost of $4 for each pool patron is determined. If the agency chooses to charge $2 per child, they are subsidizing each child coming in the door by 50%. A $6 charge for an adult would mean a 50% surplus per adult. The price of admission should be determined considering the established subsidy levels for the pool, as well as knowledge of the anticipated revenue and expenses of the operation. Once the break-even price is established, the subsidy or profit can be established. Let me repeat that. So once the break-even price is established, the subsidy or profit can be established. And a formula that you can use is S equals subsidy level. And I wonder if I have it on here. Hold on. Yes, I think that this would be helpful. Okay, so you should see it on there, sink skating, public skating, open skating, and so on and so forth. S is the subsidy level. Once recovery rates are established, the final price of the program then can be set using this formula. P is equal to the unit cost times 1 minus S, which is S is a subsidy rate. So here's an example using the skating program right here in front of you. So if you had the subsidy level at 45% and you had your unit cost, which is $22.85, the formula I just gave you then would be P is equal to the unit cost, which is 47, times 1 minus S, 1 minus 0.45. And then public skating is subsidized at 0, meaning the formula would then be, as you see it there. Open skating is subsidized at 100%, and the price per hour is free, and that's how the formula would work out. The junior hockey is subsidized at 10%, and the women's hockey is minus 45%. What does that mean if this is a minus subsidy? That means it's making a profit. And they expect that to come in at $68 an hour. Okay? So note that, it does say that here. So note that a negative subsidy is a profit, and 100% subsidy means the program is free. If the subsidy rate is 0%, then the program is priced at its break-even point. So if you all look at public skating, that's the break-even. That's 0 subsidized. It pays for itself, in other words. Okay, any questions on that before I start the new section? Okay, going once, going twice. Where did the 47 come from? So if you look back here, we did, that's a great question. So if you look back here, remember we were trying to find out what the break-even price was on the ice rink with the simplified budget. And so we went through the fixed costs, the variable cost, and we came up with this particular price point here of 106,496, but then you divide it by the number of hours, which gave you the $47. And that was just carried over to this example right here. Okay, any other questions? You're welcome. All right, so the next one is manage area-specific contracts. I'm just doing a really quick check here to make sure I'm going to be able to make it through in this next hour. Yeah, it might be tight. We might have to go into next week on this. So manage area-specific contracts. So using contractors, consultants, and concessionaires has been an increasingly common practice for agencies. The growth in this type of service is based upon the belief that some functions can be done more efficiently and more effectively by contractors, consultants, and concessionaires then it can be accomplished by in-house staff. These individuals should be viewed as a temporary expansion of the agency staff and skill base. When working with any of these three groups, a contract should be developed outlining the scope of duty, agency oversight, and performance standards. Good communication is essential to a positive working relationship with contractors, consultants, and concessionaires. Monitoring of service provisions is vital to a positive outcome. Several approaches to monitoring performance can be used. And they give they give 4. So the first one is review progress reports. And this is where you review the reports and records of I'm just going to call them the 3 C's: contractors, consultants, and concessionaires. These are typically for the submission, they're typically required for the submission on a specific date and cover a previously established time period. They can be like once a year, once a month, that sort of thing. The 3 C's can be required to supply reports that include the number of programs or activities conducted and the attendance at each function, also the revenue and expenses for each of the cost centers, noteworthy events of problems, work accomplished, and important future work or activities, among other items. The next one is inspections. We should periodically inspect the work of the 3 C's, and it usually includes some sort of rating instrument with space provided to comment on the quality and quantity of services and to identify real or hidden problems. The inspection can be completed with or without the contractor's knowledge and can be completed by internal staff, other professionals, or volunteers. Then there's a review of complaints. This is a third monitoring approach that will allow you to, if you monitor the complaints regarding the performance of the 3 C's, it's important to note that most dissatisfied people do not complain, but simply quit using a service or seek alternative service providers. That's why we must be vigilant in seeking out and addressing complaints. And the last one is the review of end-user satisfaction. A final monitoring technique is user or citizen survey, directly asking people what they believe to be the quality or quantity of the service may provide a much broader perspective that can be summarized by staff alone. Users of services are the most knowledgeable of their own level of satisfaction with services and what can be done to improve their experience or the quality. Okay, and that concludes the section on manage area-specific contracts. The next one is develop and implement fee collection procedures. Major sources of revenue for Parks and Recreation Agency are fees and charges, rental income, and retail sales, which are used to offset the cost of operations. Handling cash requires the implementation of appropriate accounting procedures to ensure that the cash is secure and placed in the appropriate accounts. Probably the easiest and simplest method to expedite cash inflow is to establish procedures for depositing currency and checks into bank accounts as quickly as possible. For smaller parks and recreation agencies with only one cash collection point and one bank account, this can be accomplished with minimal amount of effort. However, a large agency with several collection points and several different bank accounts may require considerably more effort. To improve internal processing of cash collection and deposit, each department that receives cash payment should have 3 things. The first one is revenue collection policies and procedures for each major source of revenue. 2 is establish definitive procedures for each collection location. And 3 is special deposit procedures to handle revenue processing and security. Okay. And that concludes the development and implement fee collection procedures section. The next one is recommend fee schedules and policies. Decisions regarding fees, charges, and cost recovery levels for parks and recreation services vary with the financial objectives, policies, and procedures of the agency. Many years ago, public and nonprofit agencies generally believed that services should be provided free of charge to the community if the general fund could afford them. However, with current demand for increased services and reduced taxes, as well as challenges to generate revenues, this line of thinking has changed. Parks and recreation agencies, even public ones, are operating more like businesses. Few agencies can provide the quality and quantity of services demanded without establishing fees and charges. Commercial recreation providers must ensure that revenues from various fees and charges exceed expenditures. However, these agencies must not set fees so high that potential customers are lost or ill will is created through unreasonable pricing tactics. Public and nonprofit agencies have a little more flexibility in establishing prices since programs will have varying subsidy levels. An often used approach to setting fees is differential pricing. This approach to pricing means that agencies charge different prices for the same activity based on the desirability of the facility that used, its location, prime or non-prime time hours of service, and customer characteristics such as age or the ability to pay. That's differential pricing. Using fees and charges to augment the general fund and to extend the quality and quantity of services has become a common practice in public agencies. Fees and charges are routinely set to recover costs, create new resources for other programs, and establish the value of the program offered. This is kind of interesting because a higher priced program may have more perceived value than a lower priced one. So also fees and charges are set in order to influence behavior, such as late fees, replacement costs, and promoting off-peak usage at facilities. And all of these factors, as well as cost recovery levels, will be used to establish fee schedules. The fee schedule will most likely be established annually as part of the budget planning process. Some agencies will require that the fee schedule for the year be established, while others will do this seasonally. Fee schedules may have to be approved by a governing body, especially if there was an increase in fees. And that concludes the recommended fee schedules and policies. And I'd like to know if there's any questions on that, the last few sections. Okay, then I'm going to go on to communicate budget needs to supervisor. The next section. So each supervisor will expect to have communication about the budget in different ways. In order to have an effective dialogue about your budget needs, 3 things must be done. First, one needs a thorough understanding of fees and charges. Following the process outlined in what we just covered on establishing a price and implementing the appropriate levels of cost recovery will ensure that fees and charges are correct. Secondly, a program budget must be developed. A program manager will have a variety of programs that he or she will supervise. These programs must have the revenues and expenditures detailed. The budget may require a detailed description of each program and a summary sheet for one's area of responsibility. The most important piece in communicating budget needs to the supervisor is to justify expenditures. Each line item should have a justification as to why it is needed and why it is set accordingly. An acceptable way to justify the budget is to show the worksheets for each program. The following example of a weekend trip shows the cost of each item the number of people, nights, and cost per hour, etc. So I went through this chart, and let's see if I can get it all. So there's a little bit more down here. I can't make it smaller without messing this up, but let's just kind of go through this. So you can see how they've come up with the chart. You can take a picture of this with your phone too if you want to. The charter bus, the staff, the river cruise cost. The justification over on the right is a little weak in my opinion, but you can at least see what they're trying to do. Bike tours is the easy one. That's the bike rental cost. Sunday brunch is an easy one. There's a cost per person. You can see that everybody, hotel rooms is double occupancy, and except that it doesn't include staff. In any case, you go through this exercise and you get down to $23,960. And so the cost per person is, there are 40 people coming at $599 each is the cost, the break-even cost for 40 people. The cost per person with profit is $649. This is making $50 a person. The total revenues then would be a little bit more than, of course, the expenditures because you have a profit built in. And then you'll see that where the profit is at the very bottom. Okay, any questions on that one? Okay. All right, so we're not going to make it through everything today, unfortunately. But I will cover at least the test questions, and we'll just have a little bit more to cover. What I might do is pre-record this later in the week and just send it out as a static recording, and then you can ask any questions next week on it. But I will cover all the test questions today. So the next section is, let me make sure I cover everything. Okay, good. So the next one is prepare a budget for the area responsibility. And this is a huge section, so we got to get to this one. So in theory, a budget should correctly anticipate revenues and match those with expected expenditures for a specific period of time. Usually it's a fiscal year. A fiscally sound budget will achieve a balance between revenue and expenditures, be inclusive of all financial obligation, serves as a guide to decision making, and use the financial resources available to accomplish the goals of the agency. The typical budget is completed in 3 stages. There's the preparation, there's the adoption or authorization, and then there's the execution or implementation. And it runs in a cycle. New budgets are prepared as present ones are being executed. Budget planning typically begins approximately 1 year in advance of the budgeted fiscal year. It begins when the staff are given a timeline for the budget review and submission. The timeline will be set by the chief executive of the agency in response to legally mandated deadlines or those established by the policy-making body of the organization. We should know the budget preparation timeline and procedures used in the agency. Entry-level personnel will be involved in one of 2 ways. They'll be either required to prepare a budget for their assigned area responsibility, including accurately estimating revenues and expenditures, or they may also assist an agency supervisory or administrative staff with various components of a budget preparation. Currently accepted professional practice suggests that budgets should be prepared in a cumulative fashion, beginning with the operational budgets for the frontline or program areas of the organization. Individual budgets from frontline staff are then summed and accumulated up through the organizational chart of the agency, often by the department. Department heads will then submit their budgets to the Chief Executive Officer or Chief Financial Officer. Throughout this process, there may be numerous iterations until the expenditures requested fit the revenues estimated by the agency. Budget preparation forms, as well as the overall format of the budget document, will vary greatly in the public, commercial, and nonprofit park and recreation agencies. However, there are basic elements in presenting the budget and supporting data that are applicable to all parks and recreation organizations. The budget document should detail the anticipated revenues and expenditures for the fiscal year, as well as to make clear the agency goals and objectives that will be achieved with that budget. Revenues. Revenues are monies coming into the organization. They vary by season. They can be responsive to changes in operation, subject to shifts in interest by our customers. For this reason, it's important to keep a continuous record of revenue for each operation and to analyze differences between anticipated and actual revenues. The sources of funding to support both the operating and capital budgets of parks and recreation agencies also vary greatly. Revenue comes from 5 different general sources. So again, revenue comes from 5 general sources. The first one is compulsory income. Compulsory income. This is a significant portion of revenue, and it comes from income or taxes. There's a number of different types of taxes, including real property, personal property, sales, excise, and income taxes. The next revenue stream is real property taxes. The majority of revenue from taxes comes from real property taxes. This is a tax assessed on land and anything that is built or growing on it. Real property is appraised by the local assessor, and in most cases, it assesses 30% to 50% lower than the fair market value or the value the owner would get for the property if it were sold. This appraised value is considered the asset valuation. So the appraised value is considered the assessed valuation of the property. The percentage utilized by the assessor to determine the value of the property is usually set by state legislative authority. The total assessed value of all properties within a political jurisdiction is considered the tax base. So the tax base is the total assessed value of all properties within the political jurisdiction. The tax base is then multiplied by the tax rate in the community. There are limits on the tax rate set by state legislation and local government, and we're not allowed to charge a higher tax than is allowed by this legislation. So tax rates, and this kind of out of context, but this, if you look at the page now, it says units and number of millions. The tax rates can be expressed in terms of mils. $1 equals 1,000 mils and is 1/1000th of the assessed property value. Following are conversions of various monetary units into mils. So $1 is equal to 1,000 mils. 10 is equal to 1 dime, and that is 100 mils, and so on and so forth. All you need to know for the test is just remember this formula. So if you see like 0.01 equals 1 cent, how many mils is that? It's 10. You don't necessarily have to know how to figure out taxes. At least that wasn't my experience. Personal property taxes are allowed in 41 states. They tax household and business tangible property such as cars and furniture, and intangible property such as stocks and bonds. Sales tax. Sales tax is assessed on the sale of many tangible goods. A few states do not have any sales tax, such as Alaska, Delaware, Montana, New Hampshire, and Oregon. In the remaining states, the tax rate may vary by locale. Excise taxes. Excise taxes are imposed on specific goods and services such as hotel, motel taxes, car rental taxes, and what they're calling sin taxes. And that would be like for cigarettes and alcohol. It is not unusual for these taxes to be used for specific purposes, it's not unusual for these taxes to be used for specific purposes, such as to fund conventions or visitor bureaus, or to build or refurbish sports stadiums, etc. Income taxes. In some states, income taxes are assessed on income earned. Gratuitous income. Gratuitous income is revenue received without expectation of return, including grants, gifts, donations, planned giving, and sponsorships. Earned income. It's generated through fees and charges. It is far more inclusive than a simple program fee. Earned income includes admission and entrance fees, rental fees, user fees, such as surcharges and license and permit fees. And then there's contractual receipts. And this is a major source of income. And we have the ability to contract with private agencies and individuals to sell merchandise or to provide services for us. These contracts are generally granted when the agency cannot provide a service as effectively or efficiently as the commercial organization. So some examples are boat rentals, concessions, equipment shops, instructional services, etc. Customarily, the business providing the services pays a percentage of their gross revenue to the agency and might also pay an annual fee for the contract privilege. That's interesting because I haven't seen that done. So they could also pay an annual fee for the ability to be in a contract. Contractual agreements operating on a percentage basis require the use of financial tracking systems to record all sales transactions. Receipts and tickets sold should be subjected to an subjected to an audit and inspection at the time. Contracts may be short-term or long-term and should require a cash or security bond to guarantee faithful performance under the contract, as well as a liability policy naming the Park and Recreation Agency as one of the insured. The contract should give the Park and Recreation Agency control and approval of concession commodities, the hours of business, signage, and other advertising platforms and methods of vending. Investment income. Agencies can use investment income as another revenue source. Investment income is derived from interest gained from investing agency funds into investment instruments such as money markets, stocks, and mutual funds. Some agencies will set up designated accounts, such as endowments, from donations or bequests, and use the interest from the accounts to fund special projects. Does anybody on the line actually do investment incomes, like run an endowment fund? If you do, just type in you do. I'd like to talk to you about it. We're actually going to do one this year. And if you want to find out how we did, contact me towards the end of the year. Okay, expenditures. Expenditure is a disbursement, expense, or cost related to doing business. Typically, an agency's largest expense is its personnel. Other expenses include utilities, supplies, and equipment. Budget format. Now, the budget format, let Make sure I have time for that. So I'm going to go ahead and skip this part and go. We're going to cover this in a separate section, the budget format and the cross control centers. So I'm going to move on to operate within an existing budget. Once the budget is established and approved at all levels, staff are expected to operate within that budget. To help monitor the budget, an agency may give staff access to their accounts at all times so they can check revenue projections and expenditures in each program. If this level of access is unavailable, the accounting department should produce monthly budget statements for review. And here's a potential test question. Budget statement is a report of allocated and expended monies. Allocated monies are those that have been budgeted and approved by the governing body. Expended monies are the dollars which have been spent to date. Ideally, expended monies will not exceed allocated monies in any line item of the budget. Those of us who oversee particular areas analyze budget statements to see how much money they have left in the budget compared to how much time is left in the fiscal year. This statement will allow budget to analyze their budget projections and determine if reductions in spending are needed to meet budget allocations by the end of the fiscal year. So I want to bring that up. So here's a sample budget statement. And so again, if allocated monies are those that have been budgeted and approved by a governing body. So these allocated monies are the budget, so it'd be under the budget line right here. The actual is what's being spent. The committed is typically, we use the word allocated or encumbered. This shows you the percent of the budget and then the balance. Okay, any questions on that one? Operate within an existing budget. Okay, good. I want to cover then the next section is initiate the bid process for commodities and capital acquisitions. Let's see. So Alex said this. Okay, Alex, I'm going to be calling you next week. Writing a note. Call Alex. Okay, good. In most parks and recreation agencies, items that cost less than a specific amount, and they use the example of $500, and are within the approved budget, may be purchased by the employee responsible for the area of operation without further authorization. Items between $500 and $5,000, however, may require the supervisor approval and that a specific number of price quotes be attained. And then items over $5,000 may be purchased only after formal bids are received. So I would remember those numbers, even though they're obviously every agency is different. Those are the numbers. So 500, they can just go buy. That's their spending limit. 500 and 5,000 requires a different supervisor level, and over 5,000 requires formal bids. Although specific procedures and minimal amounts vary from agency to agency, the intent is to ensure that the highest quality items are purchased at the lowest possible price. That is the intent. When price quotes are needed, the staff member details the specifications of the items needed. The specifications are distributed to a select number of vendors who will in turn provide a price quote based on the specifications. The specifications should be detailed so that all vendors are quoting a price for the same item. Staff members select the businesses from which they will allow a quote for items. While this can help eliminate businesses that are not reputable or that have been difficult in the past, it also allows a staff member to stack the quote, that's in quotations, by selecting the business they want to choose and a couple others that are traditionally higher priced or unhappy to supply the product. So to avoid this situation, the agency can establish a list of approved suppliers from which to obtain quotes. That is what you should do. Larger ticket items will require formal bids. Formal bids are much like price quotes, but follow a more structured process. And they take on different forms, including invitation for bid, where vendors submit a sealed bid based on advertising specifications. A request for proposal, or RFP, is a negotiated contract for goods and services with the vendor, which details what they will do and at what cost. And actually, the way this is wording, I believe, is actually incorrect, but it's not actually the request for proposal that identifies what cost and what they will do. That's why you're getting the bid in the first place. So it's actually the actual contract that identifies that. But anyway, they say a request for proposal is a negotiated contract for goods and services with the vendor, which details what they will do and at what cost. So when preparing bid specifications, we should provide sufficient detail to ensure the item can meet all the requirements it is intended to fulfill. However, the details should not be so specific as to eliminate otherwise qualified competitors. For example, a bid for the printing of a program brochure would contain the following information: number of pages, the weight of the paper, the number of colors, binding, timelines, deadlines, number of copies, and length of contract. The contract is then awarded to the lowest responsible bidder. The following are typical items included, and there's 5 of them. The review process for the quote bid, including deadlines. 2, the specific services required by the agency. 3, the RFPs require a budget and source of funding. Number 4, contact names. 5, a clause written into the specification that allows the agency to reject all bids. Whether bids are needed for services, goods, or concessions, the formal bidding process remains consistent with the specific procedures that are established by the agency. The comptroller within the organization is legally bound to follow approved policies, procedures throughout the bidding process. Okay, any questions? Okay, I don't see any. So it looks like I got to cover 2 more test questions, and we'll do the test in 10 minutes. So the next section is prepare financial analysis and reports, which includes reconciliation of revenues, cost recovery analysis, budget justification, and trend analysis. So most agencies will have an accounting staff member or department that handles the overall financial aspects of the organization. It is essential for each employee supervising a program to be able to monitor and operate within an existing budget. The purpose for the development and analysis of financial data are to supply pertinent data about how funds are required, safeguarded, allocated, and used. To determine whether specific cost control centers are performing adequately, and to discover ways and means of reducing expenditures by increasing revenue. There are 4 main financial reports and techniques that allow employees to monitor their budgets. And this particular section is very critical to understand So we're going to take a little bit of time with this, so we may not get through the whole entire thing. But these are the four main financial reports. So the first one is the income statement. And we're going to cover that and the balance sheet today. So let me tell you what the four are. There's the income statements, the cash flow statements, the balance sheets, and the break-even analysis. So there's also a project or program report we'll cover next week too. So what we're going to cover today is, out of those four, the income statement and the balance sheet. And then we'll cover the other ones either next week, or we'll do it via a different recording. Okay, so income statements. These statements demonstrate the profitability of the facility or cost center during a period of time, such as a month, quarter, or fiscal year. I'm going to bring that up. So here's a sample income statement while I'm going over this that you can look at. And let me ask a question. Can you all see the entire sheet? You don't see like my screen, my chat box and stuff, right? You see the entire sheet, left to right. You should see special events. Let me go down here. Can you guys see November and December and the total to the right? Can somebody just answer yes? Okay, good. Thank you. Okay, so the statement includes revenues, expenses, and net income. This is an income statement. We'll be able to analyze whether the facility or cost center is making a profit or surplus, or whether and by how much expenditures exceed revenues over the designated period of time. From the example that you see here, it's easy to see that expenditures exceeded revenues for the month by $8,523. So I'm looking for that number. So what they did was, and to get that number, is they took the 61,526 and subtracted the $53,003. And so that is an income statement. Everybody got that? Okay, good. Now, we're going to go through balance sheet next. So this is a balance sheet right here. So the balance sheet are sometimes called statements of financial position and represent the accounting equation, and this is important: assets equals liabilities plus equity. So assets equal liabilities plus equity. The balance sheet shows the agency what it actually owns and what it owes to others. So assets are the economic resources that the agency has, like land or cash or inventory. Liabilities are what the agency owes, such as a bond payment or the cost of equipment or supplies purchased that month. And then equity is the portion of the organization that is owned free and clear of any debt. So most people have never even looked at a sheet like this, and that's okay. I want to make sure you see the whole thing. Hopefully you can see most of it. And so what's important about this is that it basically shows your agency's worth, if you will, but its assets. And So assets are equal to liabilities plus equity. And so is there any questions about this? Okay, I got one note at least. Okay, so that we're going to cover the rest of this a different time because, and I might get to it after the test since we're on recording, but let's go ahead and take our test next. Okay, here we go. This will be fun. So here's the first test question. So go ahead and put your answer in there. So which financial statement shows the total revenues and expenditures for the month, quarter, or fiscal year? Its purpose is to demonstrate the profitability of the agency or cost center. Okay, everybody's saying C, and that is correct. It is the income statement. We just covered it. Okay, next question. Which of the following purchases is most likely to be made with petty cash? So you have a folding soccer goal, travel expenses under 100, $10 replacement basketball net, or meals for staff under $75. So go ahead and put your answer in. Okay, it is also C. It is tricky, you're right. And the reason why petty cash is not used for meals or travel expenses. That's one of the things the book said. And then and $125 would be over the amount for the soccer goal. So the only one that's obvious is a $10 replacement basketball net. But that's good. Okay, next one. Tax rates are sometimes expressed in mils. How many mils is $1? Okay. A is correct. Good. The maintenance foreman in charge of plumbing regularly purchase plumbing supplies at the local hardware store. These purchases are made at least 3 days per week. What is the best way to purchase items in this situation? We talked about each one of these. And it looks like everybody played. This is a room full of smart people. So B is correct. Blanket purchase order. Okay, great. The next one is room counts should be conducted how often in a busy facility? Daily, weekly, hourly, or monthly? Go ahead and put your vote in there. There's a tricky one coming up, so I'm looking forward to this one. Okay, so C is correct. Next question. Which financial statement depicts assets, liabilities, and equity, and a summary of what the agency owes and what it owns outright? Everybody should get this one. Excellent. It is D, balance sheet. All right. A couple tricky ones coming up here. A grant would be a good source of funding for which of the following projects? Trail construction, an after-school program, facility maintenance, or a new staff member? Come on, everybody. There we go. A and B. It's true. A grant could be a good. So let's see who put Becky and Brandon in. Okay, so both of you are correct. However, they choose A for the book, but I can tell you that I've gotten grants for after school programs, but we're going to go with A, trail construction, because they focused on capital expenditures. And that's what they said is the correct answer. Okay? Good job, everybody. Okay, so here's a good one. You have a break-even price point of $20. What is the cost of the program is subsidized 100%? What would be the answer for number 8? It's a trick question, isn't it? A tricky question, I should say. So, correct. It's a break-even price of $20. What is the cost of the program? I'm sorry, what is the cost if the program is subsidized 100%? It's got to be 0. So the break-even price point of 20 could be 40, could be whatever. It is 100% subsidized, so the cost of the program is 0. Okay, so gotta make sure you guys get that one. It's D, 0. Excellent. Okay, next question. Which of the following is a negotiated contract for goods and services with the vendor, which details what they will do at what cost? All right, everybody's choosing C. That's good. It is a request for proposal. And then the last question for the day. This is going to be a good one. Usually in the following budget statement, how much golf revenue is allocated? All right, everybody has to guess. All right. It is B. Very good. So my methodology worked because I've never heard that term allocated before. But it's the approved budget amount. So it's whatever's in that line under budget. Golf is 72,500. All right. So we have 11 minutes left, and so I'd really like to. What I'll do is I'll make a. We'll just have to cover this at the beginning of the next one because my voice is going. But we will definitely cover the rest of finance. And at the next meeting, which will take about 15 to 20 minutes or so, hopefully. And then we'll jump right into the next section. So I thought the next section, okay, Alex, we'll see you later. I'll call you. The next section we should do is probably communication. I'm trying to leave the easy stuff for the end. And so communication, we've done human resources. We'll have done finance next week. The two ones that I'm going to save for last are operations and programming. So please do the communication section next. Okay, I'm going to unmute everybody, and if anybody has any questions, first of all, type it in, and then I'm going to unmute for the people on the phone. Actually, nobody else is on the phone anymore. Good. So does anybody have any questions? All right. Okay, great. Well, then thank you, everybody. I will stop the recording and we will, I'll send it out just like I did. Would somebody please check the recording I sent out about an hour ago? that would be really helpful. All right. We'll see you all next week. Bye-bye.